This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Chapter 3 of Read a Balance Sheet, Financial Literacy for Non-Finance People. Understanding the Income Statement. In this chapter, you'll learn: define revenue, expenses, and net income in an income statement. Let's dive in! Last year, one of the world's biggest retailers sold over $500 billion and still reported a loss. In this episode, we step inside that paradox, how a company can feel busy, look huge, and yet its income statement quietly says you're not making money. Net profit margins for the S&P 500 averaged around 11.4% in 2022, yet individual companies ranged from wildly profitable to deeply in the red. That gap is exactly why the income statement matters. It shows not just that money moved, but how and why. In the last episode, we saw how a giant like Amazon could generate over $500 billion in sales and still end up with a loss. Now we'll go a layer deeper and start asking better questions of any income statement you see. Which expenses are eating the most into revenue? Are margins getting a little better each quarter or quietly slipping? Is a bad year the result of weak operations or a one-off hit like an investment write-down? As you learn to read these signals, you move from "is this company big?" to "is this company good at turning activity into lasting earnings?" Now we'll zoom in on how money flows through that income statement over time. Think of each line item as a stop on a train route. Revenue is where passengers board, then cash gets off at various stations: cost of goods, salaries, R&D, interest, taxes, before you see what's left at the final stop. The interesting part isn't just one trip, but how the route changes. Does R&D suddenly spike before a big product launch? Do marketing costs rise faster than sales? Are tax bills unusually low one year? These shifts often reveal the real story before headlines catch up. Look down the income statement and you'll notice a staircase. Each subtotal tells you how the company earns or loses its way to the bottom line. The first key stop is gross profit. This is what's left after subtracting the direct costs of making or delivering what you sell, things like materials, manufacturing labor, or cloud hosting tied directly to usage. For a software company, gross profit might be huge because distributing one more download is cheap. For a supermarket, it's thin because food is costly and prices are competitive. Tracking gross profit over time tells you whether the core offering is getting more or less profitable. Next is operating profit, often called EBIT, earnings before interest and taxes. To get there, you subtract overhead, salaries for support teams, marketing, rent, utilities, and under GAAP, R&D. This is the level Warren Buffett cares deeply about. It reflects how effectively managers turn the basic business model into a real, scalable operation. A stable gross profit but shrinking operating profit usually means the product is fine, but overhead is bloating. Then come items below operating profit. These are often where surprises live. Interest reveals how much the company is paying for its debt load. One-time gains or losses, selling a division, restructuring charges, or big investment hits. Taxes, shaped by location, incentives, and timing quirks. This is why Amazon's 2022 loss is so instructive. The underlying activities could still be sound, yet a large markdown on Rivian turned the final number negative. When you see an ugly bottom line, always ask, is this a new normal or a special case event? Under IFRS, you'll also see other comprehensive income, OCI, things that bypass the traditional P&L but still change equity, unrealized gains on certain investments, foreign currency translation effects, and more. Ignoring OCI can make a company look steadier than it really is, especially for global or investment-heavy businesses. A simple habit: compare 3 levels over several periods: gross profit, operating profit, and net profit. Where the biggest swings happen usually points to the real story, long before the annual letter explains it. Think of 2 tech startups that both show the same net income this year. On the surface, they look equally successful. But as you walk down their income staircases, they tell very different stories. Startup A spends heavily on R&D and marketing, but almost nothing on interest. It's pouring cash into building products and brand, funded mostly by equity. Startup B spends modestly on R&D and sales, but has a big interest line and a chunky gain on sale of investment. Its result leans more on financing and luck than on building long-term advantage. Or compare a streaming service to a chip manufacturer. The streamer might show a big content amortization expense, cash spent years ago now flowing through the statement. The chip maker may show large depreciation from fabrication plants. Both choices, content versus factories, shape how future periods will look long after this year's headlines fade. Your job as a reader is to ask, which parts of this story are repeatable and which are just this chapter? Net income is just the headline. The real power is in how it changes over time. Watch how each step on the income staircase shifts across cycles: booms, slowdowns, new product launches. In tech especially, a sudden jump in R&D or sales spend can be like replanting a field: short-term pain, future harvest. As AI and real-time systems spread, you'll see these moves sooner, but you'll still need judgment to tell strategic bets from quiet deterioration. As you get comfortable with this staircase, start testing stories. When a CEO brags about strong demand, glance down a few lines and see if the pattern agrees. Treat each line like a clue in a detective file. One clue misleads, a cluster reveals motive. Over time, you'll hear the story changing quarters before the stock chart catches up. Here's your challenge this week. Pull the last 3 months of your business income statements and calculate your gross margin, gross profit divided revenue, and net profit margin, net income divided revenue for each month. Then, circle the top 3 expense lines, like marketing, software, or contractor costs, that change the most month to month, and write the exact dollar change next to them. Finally, choose one of those expense lines and set a concrete target. For example, reduce software costs by 10% this month by canceling or downgrading 2 tools. And put a specific date on your calendar to review whether you hit it. This was OwlUp, your daily step forward. This series continues with more chapters on OwlUp.co. Visit OwlUp.co to access the complete course and continue your learning journey. See you there!